Hi again, I'm Kora, and welcome back to Tokenization 101. In our last episode, we explored the critical role of custodians in real-world asset tokenization, the people and platforms responsible for safeguarding the value behind the token. Today we're shifting gears and talking about liquidity, and the incredible power of 24/7 access to tokenized assets. If you've ever tried to sell real estate quickly, or waited 3 days for a wire transfer, or missed a market opportunity over a weekend, you already understand the problem. Traditional finance is often slow, limited, and locked into business hours. Tokenization changes that. Let's explore how and why it matters. Let's start with a basic definition. Liquidity is how easily and quickly an asset can be bought or sold without affecting its price. Cash is highly liquid. You can spend it or move it immediately. A rare painting? Not so much. You need a buyer, an appraisal, paperwork, and patience. Traditionally, real-world assets, like property, commodities, or private equity, are illiquid. It can take weeks, months, or even years to sell them. Liquidity matters because it gives freedom. Freedom to act on opportunities, to manage risk, or to exit when needed. The less liquid an asset is, the more friction there is in managing it. And friction means cost, delay, and missed opportunities. Now imagine taking that illiquid asset, say a commercial building, and tokenizing it. Each token represents a fraction of ownership or value. Instead of finding a buyer for the entire building, someone can now buy or sell just a few tokens, instantly, globally, and securely. Even better, these tokens can trade 24/7 on blockchain-based platforms instead of being limited to business hours. With tokenization, you lower the barrier to entry. You create partial ownership and fractional sales. You increase flexibility and access, and you unlock liquidity for assets that were once stuck. This isn't just a tech upgrade, it's a fundamental shift in how value moves. Let's talk about timing. Stock markets open and close. Banks have hours. Real estate deals take weeks, but crypto never sleeps. Tokenized assets, especially on permissionless or hybrid blockchains, can be traded, transferred, or collateralized anytime. That means no waiting for Monday morning to take action, no holidays shutting down the market, no missed opportunities because of time zones. It's a real-time economy. And that's powerful for both investors and asset managers. Let's take a concrete example. Imagine a farmer in Kenya who tokenizes his crop yields. Investors in Europe can buy tokens that represent future harvest income. Because of token liquidity and 24/7 access, the farmer can raise funds at any time, not just when the bank is open. Investors can enter or exit their position at any time. The tokens can be used in DeFi, as collateral, or for cross-border transfers. Now compare that to traditional agricultural financing, which might involve paperwork, high interest rates, and long waiting periods. Tokenization doesn't just increase liquidity, it democratizes it. How does this work technically? Token liquidity often comes from 3 sources: liquidity pools. These are smart contract-based pools where users can swap tokens instantly. They're commonly used in decentralized exchanges like Uniswap or Stellar AMMs. Centralized or regulated platforms. These include licensed exchanges or private token marketplaces, often used for tokenized securities and real estate. Peer-to-peer transfers, direct wallet-to-wallet transactions, especially for utility tokens or community-based assets. All of these enable liquidity, and because they're built on blockchain rails, they offer real-time visibility and low-cost transactions, often settling in seconds. Now let's be clear, liquidity isn't automatic. You still need demand market makers or buyers. A good use case or asset structure. A token without demand is just a digital paperweight. Also, 24/7 trading can be risky. With no downtime, markets can be volatile. That's why governance, regulation, and proper investor education still matter. But when done right, liquidity and access empower participants across borders, income levels, and industries. So what did we learn today? Liquidity is about ease and speed of converting value. Tokenization turns illiquid assets into dynamic instruments. 24/7 access removes barriers created by time, geography, and institutions. The impact is global, especially for underserved markets and asset classes. Tokenization isn't just about technology. It's about mobility of value. In our next episode, we'll explore the difference between on-chain and off-chain data, and why that matters when you're tracking and verifying tokenized assets. Until then, I'm Kora, and this is Tokenization 101. See you in episode 13.